Inflation. Over the past year, warnings of inflation have grown significantly, with the Fed printing trillions of new dollars. Now, one of these voices warning us about inflation throughout has been the legendary investor Ray Dalio. Months ago, he shared why he believes inflation was not transitory, as was claimed at the time. He was right. In this video, we're going to hear Dalio's updated thoughts on inflation today, and where he sees the state of the market in this current climate. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. Let's get straight into our first clip.
Are currently observed rates of inflation in the United States going to be transitory? And what do you understand by that term?
Well, I'll start by what I understand by the term, and then I'll answer your question. By transitory, I think everybody understands that to mean temporary shocks that don't become chronic, and therefore we don't have a chronically higher rate of inflation. We have, it sort of settles back to the older rates of inflation that existed before it, but it doesn't, it's not a problem. That's what I mean by a transitory. Do you agree with that definition? No.
Sure, that's fine, yeah.
Okay. So in terms of, no, I don't believe it'll be transitory. I believe that there are two main sources of inflation. There's the usual supply and demand for goods, cyclical inflation, so that when there's a demand for something, that there can't be a greater amount of supply being produced for it. There's an upward pressure in that price, and so that comes from strong demand pressing up against capacity limitations. That's cyclical inflation, and it depends on how far the central bank accommodates that. So that's the cyclical inflation. The second is monetary inflation, when the production of debt is large, but the central bank produces more money and credit. That has the effect of devaluing the value of money and credit, which doesn't show up really as it doesn't look like it is going down as much as it looks like other things are going up, so that you see things going up as they are now, and that's monetary inflation. I think right now we have both cyclical inflation and monetary inflation, so that if you look at the demand for everything right now, the demand is greater than the capacity. It's really a excess demand issue, but provided by a lot of money and credit being put out. And we also are running large deficits. And as we start to look farther forward, we have these very cheap interest rates, which means that it pays to buy things like let's say houses. I mean, practically, there's no interest rate to speak of. And now a lot of loans are made on interest-only loans even. So with hardly any interest rate and not having to pay back principal payments in terms of the amount of ridiculousness that it's gotten to that way, there's a lot of demand for those kinds of things. And now that could be cyclical, but I don't believe when I look forward that our deficits or will be primarily cyclical. So I looked into the issues of politics and the issues of the deficits and the needs for money and credit, or the desires for money and credit, and I think that they'll be structural. And I think then also there are certain changes in expenses. For example, while I believe that climate change and moving to cleaner energy and other such moves is very good for our ecosystem in the long run, it's also very expensive and it makes less efficiency. So that's going to, at that same time, add to inflation. So yeah, my worry or belief is that that will increasingly be built into the process, which we're seeing, for example, in terms of changes in compensation, changes in many, many things. Everybody's seeing inflation around them, and it's not just something that's going to settle back. So if I take the cyclical piece, it's going to require enough of a tightening, if you were to deal with that, enough of a tightening in monetary policy to stop that buying, and that the consequences of that would be very bearish for markets, and it would be very bearish for the economy, and I believe too bearish for the Federal Reserve to want to tolerate. And that would only deal with the cyclical inflation pressures, whereas at the same time, we have the structural issues of those kinds of deficits that need to be monetized. So for those reasons, I don't believe it's transitory, that we will go back to what we experienced before.
But if I look today, say at equities prices, they seem fine. If I look at the 10-year yield for the U.S., it's not crazy high. Should I just assume that these matters are more or less going to work out fine, given those market prices, or are those prices wrong?
No, I think you have to look at the dynamic behind those prices, and I think I would look at them a bit differently. Regarding the dynamic behind those prices, it is that we are spending more than we are earning by a lot, individuals and the country as a whole. And that we need money, partially because of the political issues, partially for all the reasons that you know. So a lot of debt debt is being created that is also producing the need for a lot of money. And as a result of that, we have very negative real interest rates. Real interest rates of short-term interest rates are significantly negative, and even bond yields, real bond yields, are over 100 basis points negative. And so when one looks at the return of owning those bonds, that is a very bad return. It means that if you save in those assets and you put it away, that you will lose buying power at probably a rate of 3 to 5% per year. We can guess what inflation is, and we can talk about that. But you will lose that, and that tax on your buying power makes one will not want to be saving in those assets. It makes one want to borrow in those assets, and the available of credit and that set of circumstances drives money into other assets, and into those assets are in investment assets as well as goods and services. And so what we see now is that stocks are not expensive, not very expensive, maybe a little bit more so than normal, relative to bonds, which are very expensive, but still not expensive in relation to cash. And so they are all having expected returns that are comparatively low, and we have an inflationary period. So it's very important to understand the paradigm that we're in and how that dynamic works. And so as the inflation pressures become an issue, and we have relatively, let's say, stronger growth, those things will start to change. And so the big question that the markets look at is, how will that change? As a result, will the Federal Reserve and central banks begin to tighten monetary policy? Because these things will change. And what will tax policies be and the like? And those things will affect market prices going forward. It's unsustainable.
So Dalio raises some very interesting points. In particular, he describes the two types of inflation and why he believes inflation is not transitory, i.e. it's not going away anytime soon. So the two types of inflation are cyclical inflation. This is where the demand for goods and services is higher than the supply, and this is true today. And there is monetary inflation. This is where the Fed is printing large sums of money and effectively devaluing each individual dollar. This type of inflation is also present today. So the fact that today's situation involves both types of inflation, it's problematic. It means the response required to curb inflation will have to be extreme enough to tackle both at the same time. In fact, as Ray Dalio says, if the Fed wants to tackle just cyclical inflation alone, there would have to be a significant tightening of the monetary policy. Now, the issue here is the consequences of tightening too quickly could be severe for the stock market and the wider economy. And even if the Fed were to do this, it still wouldn't fix the underlying structural issues leading to inflation. So the Fed is essentially walking on a tightrope. If they tighten things too quickly, it would act to curb inflation. However, it would also restrict the economy. If they don't tighten things quickly enough, inflation could get out of hand. Unfortunately, this is exactly what happens when the central bank prints trillions of new dollars in the space of just a couple of years. And as Dalio sees it, there is only one path from here. Ultimately, the Fed will not be able to tighten quickly and effectively enough to quell inflation. As a result, we can expect to see inflation continue to rise for the foreseeable future. Now, I'm keen to hear your thoughts. Inflation is clearly here, but do you think it will continue to rise, or do you think it will trail off? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.